Singapore REITs has been on the rise, with Singapore solar rates falling and the US government expected to cut interest rate. This will definitely benefit the overall markets and REITs in general, as their dividend yields will start to look more attractive once used in savings accounts, bonds, and government treasury starts to come down. That is why equities, especially Singapore REITs, are experiencing a rise in their share price as people start to see their dividend yields being more attractive. In this video, we will go through the 3 REITs results, which is Keppel DC Reit, Keppel Infrastructure Trust, and Keppel Reit. Their dividend yields are priced very differently because of various reasons. And we will also see why Keppel DC Reit continues to be the best performing REIT in Singapore. Now let's get into their respective results. Keppel DC Reit is one of the rare REITs in Singapore that has been impressive so far and definitely benefiting from the cloud demand in data centers due to the development of AI. Keppel DC Reit now has 24 data centers and have been growing significantly thanks to additional acquisitions and the rising demands. Looking at the key highlights, they continue to impress with distributable income increasing by 57% year-over-year, while DPU increased significantly by 12.8%. Moreover, portfolio rental reversions was up by a huge margin of 51%. This is due to a single major contract reversion, but this shows the strong demand in data center spaces in the countries that Keppel DC properties are in. Leverage ratio is fantastic at 30%, which gives them the room for future growth. With interest rates coming down, it will be a good time for them to start looking for more opportunities. Looking at their results, income is up higher than the revenue, which is good as this meant that their operations are more efficient. Thanks to the acquisitions of Keppel DC Singapore and the Osaka properties, on top of the strong contract renewal, Keppel DC Reit is one of the best performing REIT in Singapore. Finance income was also up thanks to the Australia DC notes, which proved to be good. Additional good news is that their finance cost is down, which led to a significantly higher distributable income of 57%. Shareholders who have bought the dip on Keppel DC Reit would now have been enjoying dividend yields of around 5.1% on top of the capital gains. With the high rental reversions, I would expect this trend to continue as long as US cloud companies like Oracle, Google, Amazon, and Microsoft continues to report on high demand for their cloud spaces. They aim to acquire the remaining interest of the 2 new Keppel DC Singapore 7 and 8, and it's important to see how much it will take for the lease extensions for both of these properties. With the interest rate in Singapore coming down, I feel that taking the loans now is a very good time. Moreover, with the lower leverage ratio, acquiring new data centers and expanding is a good opportunity for the REIT. More good news is that they are performing land lease extension for Keppel DC Singapore 1, and we will see later on their building land leases. Unfortunately for this year, there are only 1.5% remaining of contracts left to renew, which might limit the growth in their income through contract renewals. Currently, with such a huge growth in their income and low leverage ratio, Keppel DC Reit is one of the healthiest REIT. Leverage ratio is low at 30%, while cost of debt continues to drop due to lower floating rates. We can see that their cost of debt have most probably peaked as they managed to refinance all of the 2025 loans, with their average cost of debt coming down. Moreover, they have obtained green loans for their new properties, and it's good because green loans tends to have lower rates due to buildings being more environmentally friendly. Moreover, it's smart for Keppel DC Reit's management to target new data centers in Korea, Japan, or Europe, as they have decent power supplies and vacancy rate in Europe is at a record low, which shows the rising demand for DCs in that region. For Keppel DC Reit, their main risk that many investors mention about is the remaining land leases that they have. We can see that for Singapore data centers, it's around 15 to 30 years, but to me, I would expect them to have no issues extending the leases with the government, as it does not make sense for the government to take back the land while it's providing good business for Singapore. The only problem would be the cash required to be paid for the lease extensions. Keppel DC Reit also have Kwantong data centers that still do not have any news or updates. Even without the contribution from 5% of their assets, Keppel DC Reit is still impressively able to provide higher income and dividends for shareholders. Hopefully we will get some good news soon, or the sales of these 3 properties would also be good. As I made this video a time back, they have actually acquired Japan data centers in Tokyo, and this is fantastic. They are acquiring 98% of the ownership, with the land lease being freehold while occupancy is at 100%. Moreover, the tenant is a hyperscaler, which makes it even better and sustainable for the long term. With the completion of the data centers expected at the end of 2025, we should expect these data centers to increase Keppel DC Reit's DPU next year. They mentioned that it will be 2.8% increase to their dividends, and thanks to the fundraising, their leverage ratio will be at 34.5% after acquisition, which gives them more headroom for future purchases. The finance will be done with 473 million of new debts, while 229.8 million is done through preferential offering. As Japan interest rate is very low, I feel that this is a very smart move, as taking loans in this country will be very cheap. The preferential offering will be done at 5.2% of its share price discount at $2.24, which is decent, as you do not want REITs to raise preferential offering with a price that is too cheap. So for every 1,000 shares, you will be entitled to 80 shares to purchase at discount. However, do not hesitate to apply for excess shares if you are very confident with Keppel DC Reit. This preferential offering will be applicable for shareholders holding shares before 26 September. You have until 13 October to apply for it, and the new shares will be issued and start trading on the 22nd of October. So let's conclude Keppel DC Reit's results. Thanks to the strong demand in AI, data centers will continue to do well, with more cloud storage are required for daily consumption. They have amazing debt profiles, with their average cost of debt continuing to drop, showing peak in their debts. Third, we will focus on how much does it take for Keppel DC Reit to have their land lease being extended for Keppel DC Singapore 1, 7 and 8. You can also see the retirement website where he compares on the 3 data center REITs overall results. Overall, I feel that Keppel DC Reit will continue to be one of the best performing REIT in Singapore. At their current share price, their dividend yield is at the range of 4.3%. Next, let us go to Keppel Infrastructure Trust. KIT is a business trust which gives out most of its income as dividends. Like their name says, they focus on infrastructure assets rather than properties. They have many different assets related to utilities, but are mainly categorized into energy, environmental services, and distribution and storage. In recent times, they have announced the acquisition of Global Marine Group, which is a subsea cable provider from Keppel Infrastructure Fund. Subsea cables are electrical cables laid on seabeds. Interestingly, they have also partially divested part of the Ventura, which was just bought last year, 2024. With such aggressive purchase and divestment, it's important for their overall portfolio to increase their income to reward shareholders. Looking at the individual breakdown of the sector performance, we can see that overall is down 7.8% year over year. City gas and German solar was higher but was brought down by transition and wind farm assets. AJBU, which is Aramco gas pipeline, came in lower due to higher interest paid after refinancing, which is not good because this meant that their cost of debt is still increasing in that asset. Wind farm was disappointing as the unusual low wind speed have resulted in lower income. This shows that the wind farm portfolio can be quite unpredictable as the performance is dependent on environment, which is something nobody can control. Environmental services is very bad with 37% drop. Singapore wastewater is surprisingly low even with the contribution from Keppel Marina East Desalination Plant. Moreover, they are also exploring the extension for Sing Spring Desalination Plant, which is expiring this year. This meant that additional money must be paid for the extension, which is extra cost for KIT. Distribution and storage section is performing decently, with Ixom continue to be the crown assets, while Ventura is continuing to do well. However, they have recently divested the Philippine coastal, and we will see if the new asset, Global Marine Group, that was acquired will be able to provide better returns for shareholders. If we see the overall performance, although year-over-year the distributable income is up by 31%, it was mainly boosted by the divestment of 50% in Philippine coastal. Moreover, with the partial divestment on Ventura, there's a risk that the upcoming quarter's income will be lower due to lower contributions. Looking at the debt profile, surprisingly, their average cost of debt continues to increase from 4.51% to 4.79%, while other REITs have their cost of debts decreasing. So it will be interesting for the upcoming year to see if the loan renewals for the large chunks of debts in 2026 will affect the overall distributable income for KIT. Therefore, with the current dividend of 1.97 cents, the total amount needed for this distribution is 119.9 million. This is 123% compared to the total income if we do not include the divestment gains from Philippine coastal. They have to top out the dividends with their cash, and this is one risk that shareholders do not like. With dividends payout ratio of more than 100%, this essentially removes any potential for growth in dividends because they are already having difficulty maintaining at this level. We have to see closely how the new assets GMG can provide additional income for KIT. At the current share price, its dividend yield is around 8.3%. Now let's go on to the last REIT, and that will be Keppel Reit. For those who are not familiar with Keppel Reit, they are a REIT that focuses purely on office buildings with majority of their properties in Singapore. Looking at their key highlights, net property is up but distributable income is down. Lower distributable income was due to the change in management fees payment in cash instead of units. If you look at their performances, it's decent with NPI, net property income, growing strong at 11.8%, but with borrowing costs increasing significantly, it led to a drop in distributable income of 1.4%. Based on the description, for the first half of 2024, the management fee were fully paid in units, while this year, the management opted for 25% of its fees in cash. However, this is not good because if we see for first half of 2024, Keppel Reit's share price is actually lower compared to now. Management fees paid in units will always artificially increase the amount of cash available to give to shareholders and will dilute shareholders in the long term. So it's important that the management balance this, as opting for units during higher share price will lead to lesser amount of dilution. However, for this case, it looks like the opposite is happening with the management opting for units during the lower share price while receiving cash during higher share price period. Looking at the individual breakdowns, it's good across the board with NPI higher across various countries thanks to higher occupancy or income. This is impressive considering office assets are considered to be an industry affected by work from home policy. Keppel Reit continues to be strong with higher rental reversions of 12.3% and occupancy of 96%. More good news is that Singapore office demands continues to be strong with both properties achieving good rentals, which will definitely boost Keppel Reit's income. If we see their debts, leverage ratio is quite high at 41.7%, while cost of debt is at 3.5%. Like I mentioned last quarter, due to the rise in the cost of debts, this led to higher borrowing costs of 12% year over year. On the bright side, they have managed to refinance all of their 2025 loans, and they mentioned in this statement that the loans were actually refinanced at lower margins. This might be hinting that the debt payments for Keppel Reit might have also peaked, and therefore we should expect to see their borrowing costs start coming down. So in conclusion, Keppel Reit has good rental reversions with good properties. Management fees in cash led to lower dividends temporarily. Loans might have peaked and we might expect to see subsequent refinancing to have lower interest costs. Lastly, we might see lower dividends for this financial year, but long terms, their dividends might continue to increase. At the current share price, its dividend yield is about 5.5%. In conclusion, Keppel DC Reit continues to be the standout performer out of the Singapore REITs, but Keppel Infrastructure Trust and Keppel Reit might hopefully see peaks in their interest payments. For Keppel Infrastructure Trust next quarter results, we will see whether their new assets can perform well. Moreover, it's important for them to see whether the potential dividend payout ratio are sustainable. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment your thoughts on the 3 Keppel earnings. You can also watch my recent analysis videos on Singapore REITs or Singapore banks. Thank you, and I'll see you in the next video.